So in today's episode, we have a client with a $2 million portfolio and a pretty healthy income to expense ratio, meaning what they're going to take from their assets. That percentage is less than 4%, which is usually a good sign. However, the client came to us because they're currently under the assumption that they're going to be all right. However, as you guys have seen in other episodes, that when you start stacking on different retirement risks, that's not always the case. I'm going to also introduce you guys to Monte Carlo today. It's just a way of stress testing the plan. It's running a bunch of instances in order to really try and figure out what the probability of success for any given plan is going to be. So without further ado, let's go ahead and jump into a planning session. So here we are on the dashboard of the client. We've got a 59 and 58-year-old. We see a total net worth here in the blue box of about 2.2 million and about 1.7 in the green box. That's their investable assets. Let's jump over to cash flow. You guys know that's usually where I start because we want to see how their income and expenses are working together, if there's a shortfall, if there's positive cash flow and whatnot. So looking at their income flow, they've got about $200K per year over the next 3 years because they will continue working up until 61-60 and then retire in that next year at 62-61. So pretty healthy income here in the first few years before retirement. Looking at total expenses, I mean, that's not too bad. 143, upwards of 160 right before retirement. And that leaves us with a positive net cash flow because the difference between their expenses and their income is positive. And that is by 54 or so in that first year. And that's being added to their total portfolio assets. Now, I set those assets to grow at about 4%. This client is ultra conservative. So if I make my way into investments here and we click on qualified, for instance, we can see Mr. Client's 401k is set to grow at about pre and post 3, call it almost 4%, 3.8%. Now moving back to that cash flow summary, we want to make our way down to retirement and see how things look then. So here they are retired at 62 and 61. Now their income drops dramatically down to about 40,000 or so per year for the next, call it 5 or 6 years. Now, let's take a look at income flows to see what the primary source of income is in those first few years of retirement. And we can see it here. The client has business income, most likely a rental property. I'd have to look back at the notes. And they're positive on that rental income, about 40K a year. That's after, everything, all expenses that's net operating income. So he's got about 40K per year coming from that rental property. And if we keep looking over to the right, we can actually continue with our income flow on the right. We know it's about 40,000. And then what ends up happening down here in the future is it bumps up by, call it 62K. And a full, in the next year, there's a full 12 months. That's Social Security income. So Social Security income kicks on here closer to the first of the year. I would bet that their birthdays are earlier in the year. So they almost got a full 12 months of it. And then in that very second year, that is a full 12 months of their Social Security income. And we can see their income bumps to about 100K. Now, going back to that previous screen, I want to focus in on those first few years where they're only earning about 40K. And so if we're looking here at 62, 61 in that fourth year when they're retired, against their expenses, which have fallen dramatically, mostly because of taxes, they're going to have a negative annual income. So they're going to have a shortfall of about $65,000 per year. Now, as we've learned in previous episodes, that is made up out of your assets. And their assets are pretty healthy at that time at about $2 million they've grown up to, with all that positive net cash flow on a year end being added plus about 4% per year. So they're at about $2 million. Now the question is, as a percentage, how much is that of their assets? Meaning, how much do they need to earn in the market in order to make up that shortfall? So we know they're making 3.79%. We just looked at that. What are they taking? Well, 3.15. So here we see not just capital appreciation where the client is earning as much as they're spending, but we see capital appreciation where the client is earning the returns from the stock market on their assets are greater than their annual shortfall. The difference between that $40,000 that they're earning from that rental income and their $100,000 cost of annual expenses. So 3.15, and if we look, that remains about the same throughout retirement. There's a few years here when Social Security kicks on, and that drops quite a bit. And we see that for several years. And then we're getting down here and it jumps. Why? Why is it jumping at his age 72? Well, without giving you too long to answer, it's because of RMDs. The government is requesting, or I should say requiring, minimum distributions from the accounts you have not paid taxes on because, well, they want to get paid. So we see that happening, and that forced income is driving their withdrawals up. It's kind of an artificial thing that happens here, but it is driving up their annual distributions from the retirement accounts. And so it's 2.89%, and that's growing over time. But this is actually a really good looking plan. We're well under the 4% target we want to be under. And that's sustained throughout almost all retirement. At first sight, it looks as though this client's in a good place. What I'm going to introduce next is Monte Carlo. And Monte Carlo stress tests their plan against 1,000 simulations. And what it's doing is it's taking that rate of return, that 3.79%, and it's changing it every year. So some years it'll be positive, some years it'll be negative, because that's the natural flow of the market. And we're going to see what percentage of probability of a successful retirement they have when we introduce that variable. So let's jump back to the plan. So we're back in the client's plan. I changed the report to Monte Carlo, and Monte Carlo is going to help us understand how the client's plan looks with the natural flow of the markets. When I put in that 3.79% pre-post retirement return on their portfolio, that's linear. So every year we'll provide them with the 3.79% return. But that's not the natural flow of the markets. Sometimes the market's up and sometimes the market's down. So based on Monte Carlo and the market's natural movement, what is the probability of success for this client? And we can see here the definition of the Monte Carlo, 1,000 trials. Well, on the upside, at 97.5%, client will end up with 7.5 million at both their deaths. In the middle, 50% of those cases, they ended up with about 6 mil. And on the downside, about 2.5% or 25 of those 1,000 trials end up at 4.8. So this client, if both of them live to age 100, meaning that they will continue receiving their Social Security benefits, they have that rental income. If that is the case all the way through retirement and their expenses don't change much, well, then they can expect a 100% probability of success, meaning they will make it all the way through. So to most clients, this would look like the perfect plan, which is why we're going to stress test it next. It's very unlikely for both clients to live to age 100. So the first thing we'll start with is income. If both clients don't live to age 100, if one of them has a premature death, then that Social Security benefit will be released from the plan, meaning they won't have as much income every year, and that should produce a bigger shortfall. So let's start with premature death and loss of that income and see how the plan holds up to Monte Carlo. So I'm back in the planning software, and I went ahead and created a duplicate of the plan we've been looking at, but I'm going to change the assumed date of death from age 100 for the client to age 65 like you see here. So let's jump over to reports, look back at the cash flow for that plan. Mr. Client, premature death, and we need to hit update, and there we go. So moving down here, we see the client, this gray line across the screen, that's the client's date of death. Now, we know their income at the age 67, 66, right in here, jumped to about $100,000 per year because Social Security and because of that rental income. So their two Social Security combined with that rental income was about $100K per year. But here we see the client's income has not changed to reflect that $100,000. As a matter of fact, this is this client's Social Security benefit only, the higher of the two. And we can see that by clicking on this income flows. And if we look down here, so client worked for 3 years and then they both retired. We know that we had that business rental income, but we see that that stops at his death. So likely that's business income. If it's rental income, oftentimes with affluent individuals, you will see them pass their properties down to their heirs. So she wouldn't have assumed ownership of that rental property. Maybe an heir did, but it's likely to be business income. Regardless, it falls off. And the Social Security income is much lower too. It's the higher of the two at about $41,000 per year now. So that creates an even bigger